What if I told you that the modern banking system didn't begin in London, or Amsterdam, or even New York, but in a city built on water, with no land, no gold mines, and no army powerful enough to conquer empires? Venice. Here's the mystery, and more importantly, this is the story of how Venice became a bank, how that system nearly collapsed under its own weight, and why the same patterns are repeating right now. Part 1. Origins. A city with nothing but trust. Unlike Rome, Venice had no vast farmland. Unlike empires, it had no massive standing army. Built on islands in a lagoon, Venice sat at the crossroads between East and West. Spices from Asia, silk from China, gold from Africa all passed through Venetian ports. Merchants faced constant dangers, shipwrecks, pirates, war, theft. Carrying gold across seas was risky and inefficient, so they invented something radical for the time. Instead of carrying physical coins, merchants deposited gold with Venetian institutions and received written credits. These credits could be transferred, exchanged, and settled later. Money began to move, without moving. It was trading promises. By the 12th and 13th centuries, Venice formalized this system. They created state-backed financial institutions, including what many historians consider the first public banks. The most important was the Banco della Piazza di Rialto, founded in 1587, but its roots went back centuries earlier. Here's what made Venice different. Transfers were recorded on ledgers, not coins. Merchants trusted Venetian banks more than kings. The city realized it could spend money, didn't physically hold as long as confidence remained high. Sound familiar? To fund wars and infrastructure, the state issued forced loans called prestiti. Citizens were required to lend money to the government in exchange for interest. These debts became tradable. Debt itself turned into a financial product. Venice had effectively created a bond market, a state-backed banking system, a proto-central bank, all before modern economics existed. Venice wasn't just a city anymore. It was a financial operating system. Part 3. The breaking point. When paper promises multiplied but success planted the seeds of failure. As Venice grew richer, it grew more dependent on financial engineering rather than real economic growth. The state began borrowing more, not just for emergencies, but to maintain lifestyle, bureaucracy, and constant wars. Here's the critical shift. Venice stopped asking, "Can we repay this?" and started asking, "Can we roll it over?" Debt became permanent. Banks expanded credit far beyond physical reserves. As long as trade flowed and trust held, the system worked. But Venice faced new threats. The Ottoman Empire blocked eastern trade routes. Atlantic powers like Portugal and Spain bypassed Venice. Gold and silver flowed directly to northern Europe. Venice's real economy weakened. But its financial obligations didn't. To survive, Venice did what many governments do today: increased borrowing, manipulated currency values, restricted withdrawals for citizens to keep money in banks. Confidence began to crack. Fallout. When trust started to evaporate, financial systems don't collapse loudly at first, they whisper. Venetian banks began failing one by one. Depositors discovered that ledger money couldn't always be converted into real coin. The government responded with controls. Withdrawals were delayed. Payments were frozen. Temporary measures became permanent. Sound familiar again? Venice tried to preserve trust by outlawing doubt. Criticizing the financial system became dangerous. The state needed belief more than truth, but the damage was already done. As global trade shifted away, Venice's financial dominance collapsed slowly, not suddenly. By the 18th century, Venice was no longer a financial superpower, it was a museum of past glory. And in 1797, Napoleon ended it completely, not with armies, with irrelevance. Failed fixes. Why the system couldn't be saved. Venice attempted reforms. New banks, currency adjustments, did restructuring, but every fix treated symptoms, not causes. The real problem was structural. Too much debt to little growth, too much reliance on confidence. Once a system depends on belief rather than productivity, collapse becomes inevitable, and that's a matter of timing. Venice didn't fall because it invented banking. It fell because it never stopped expanding it. To Part 6. Modern parallels. The pattern repeats. Now here's where this stops being history and starts being uncomfortable. Today, global debt exceeds $300 trillion. Most money exists only as digital entries. Banks hold a fraction of deposits. Governments roll debt indefinitely like Venice. Modern economies rely on confidence, credit expansion, debt as growth. Central banks don't ask, should we create money? They ask, what happens if we don't? Venice believed it was too important to fail. So, do modern financial systems. But history shows something brutal. No financial empire collapses because people understand it. They collapse when people stop believing. Final takeaways. Takeaway 1. Money is not wealth. It's a system of trust, and trust can evaporate. Takeaway 2. Debt can fuel growth temporarily, but permanent debt always demands a reckoning. Takeaway 3. When a system prioritizes stability over truth, collapse becomes inevitable. Final thought. Venice didn't fail overnight. It faded while insisting everything was under control. The question isn't whether modern systems resemble Venice. The question is, how far along the same path are we?